If you're filing a 2026 tax return and your secret goal is, please God, don't let me get audited, this video is for you. I'm a tax attorney. I see what actually triggers audits and what gets people in trouble when the IRS shows up. In this video, I'm going to show you a simple checklist to make your 2026 tax return as close to audit-proof as possible, and a system so that if you do get audited, you can sleep at night instead of panic Googling at 2 a.m. I'm Brad Paladini. I'm a tax attorney. My firm helps individuals and business owners solve tax problems so they don't lose everything. Two quick truths before we dive in. One, there is no way to guarantee you'll never be audited. Some audits are random. Number two, you can still dramatically lower your odds of getting audited by being prepared before you file your tax return. Here's the plan for today. First, how audits really get triggered in 2026, no hype. Second, the top red flags I see on actual tax returns. And number three, a step-by-step audit-resistant return checklist you can literally copy this year. If you find yourself under audit and need some help, there's a link down below where you can schedule a consultation with our office. Otherwise, take the information you used here, use it to audit-proof your return in 2026. And if you like this video, take a moment to like and subscribe. How do audits really work? Let's kill a myth. The IRS is not just sitting there personally reading your tax return thinking, I hate this guy. Most audits start with computers, not human beings. At a simple level, there are three main things that can trigger an audit. Number one, your numbers don't match what the IRS already knows about you. You get 1099s and W-2s and 2Gs for gambling income and employment income and interest income. The IRS already has all of that information. And one of the first things their computer is going to check is all of that information already on your tax return? And if it's not, there's a pretty good chance you're going to get a letter in the mail from them. Number two, your deductions look way out of line compared to similar businesses or what you've done in the past. Number three, you could be in a category that the IRS is focusing more on now, like high income non-filers, people with big Schedule C income or losses, refundable credits, cryptocurrency, foreign accounts. If you're in one of those categories, your risk of being audited could be increased. So audit-proofing your return in 2026 is really about matching what they already know, staying inside sane ranges where you can, and having bulletproof backup for anything that is unusual. Here are some big red flags, some patterns that get clients into trouble. Number one is that unreported income. We handle so many audits where people have not properly reported their gambling winnings. The IRS gets a copy of everything the casino or online account has reported in terms of what they think you won in a particular tax year. The IRS doesn't know how much money you lost. That is up to you to report. But if you're leaving that information off of the return, there's a very good chance that you're going to get some sort of letter from the IRS. I never got the form. I never got the 1099 is not a defense. If the IRS got a copy of the form, you are expected to have it on the return. So what you could do is potentially file an extension, wait for the IRS to update their records, and then you could get a copy of what's called a wage and income transcript, which is going to have all of the 1099s and W-2s and every other form that the IRS already has on file for you. Schedule C madness is another area we see all the time with huge issues. If you are showing losses on your Schedule C year after year after year, while simultaneously living a pretty nice lifestyle, the IRS is going to have questions for you. Like, how does your business continue to lose money year after year while you afford this $2 million home, right? There will also question stuff that maybe could be abused and more of a personal expense rather than a business expense. Things like travel and meals and home office. Those expense categories are always a red flag for the IRS if they are disproportionately high to similar businesses. If you have two perfect numbers on your tax return, that is also a red flag. I've seen so many tax returns that I've just glanced at, and within 5 seconds, I know it is nonsense, right? You have an even $50,000 in advertising expense and even $50,000 in travel expense. You have $20,000 exactly in meals. The IRS knows you're guesstimating and that you probably don't have the backup you need to prove those expenses. Refundable credits, also a big area with the earned income credit, child tax credit. All of those credits, you want to make sure that you have the proof needed if you're ever to get audited for those categories. If you're just a really high income earner or you have a complex return, those are also other areas to watch out for. So if you have not only a Schedule C business, but you have a bunch of Schedule Es for rental properties, there are a lot of things that can go wrong there. The IRS knows that. And those are the items that they're going to be looking at. How do we come up with an audit-resistant return in 2026? Step one, you want to match the data that the IRS already has on file for you. So I talked about earlier, potentially filing an extension, waiting to get your wage and income transcripts so you can make sure all of those 1099s are on your tax return, or just make sure that you're logging into all of your accounts, your, Amex savings account, your Vanguard brokerage account, and downloading all of those 1099s, along with, if you do gambling online, getting a copy of all of those records and providing those to the preparer before you file. So make a list of every place you earned money in 2026. That's from jobs, that's from businesses, that's from side hustles, that's from gambling, interest income, income from selling stocks, and make sure you have all of the records from those sources on the tax return. Don't file your return before confirming that you have every W-2, 1099, and tax document. Step two, be careful with what you deduct. You want to deduct things that you can defend. So think about it this way. If the IRS agent were to ask me tomorrow, could I hand them receipts and a simple explanation without breaking into a sweat? And if the answer is no, then it's probably not a good deduction. Step three, keep a year-round audit file. So me personally, for my business, I have a separate folder in my Outlook account. And every single receipt I get goes into that separate folder. Now, if you want to get really fancy with it, you can actually link those receipts to your QuickBooks file or your accounting software file. So you can link every individual receipt with every individual transaction in your accounting records. I'm not that fancy. That's way too much work for me, and I don't want to pay an accountant to do it. But I know that if I'm ever audited, I have one folder in my Outlook with every single receipt for every single expense I incurred during that tax year, and I can find it in probably 5 minutes. So make sure that you have one folder where you are keeping all of your receipts. Step number 4, sanity check your story. Take a look at the whole return and say, does this actually make sense? So if you're a business owner with $100,000 of gross receipts for the year, and you have $150,000 in travel expenses, and you have another $100,000 in auto expenses, which, by the way, that was a real case, a real audit that I handled for someone, that doesn't really make sense, right? Why in God's name are you doing so much traveling for so little revenue, and your auto expense is literally 50% of your gross receipts? Does that make sense? No, it doesn't. Step number 5, perform a bank deposit analysis. What's a bank deposit analysis? You get all of your bank records for the tax year. you add up the deposits into the account. And then from there, you want to subtract out anything that's not taxable. So that would be things like you got a loan and you deposited that money into your account, or you transferred money from one business account that you had to another business account that you had. It'll show up as a deposit in the account, but it's not a taxable deposit. So get a total figure of what all of your taxable deposits were for the year and compare that number to the gross receipts listed on your tax return. This is literally the first thing that the IRS will do when they start an audit. It's the first thing we do when we are defending a client in the audit. I had a client a couple years ago who handed me his tax return and his bank statements. He showed $1.5 million of gross receipts on his tax returns. When we added up all of his deposits into his account, there was $4 million in taxable deposits into the account. What does the IRS think? That it's all additional income and they're going to tax you on the difference. So make sure that the number that you're putting as gross receipts on your tax return more or less matches the total deposits going into your bank account. If you find yourself under audit and need some help, there's a link down below where you can schedule a consultation with our office. Otherwise, take the information you used here, use it to audit-proof your return in 2026. And if you liked this video, take a moment to like and subscribe.